Good morning. CRE CLO distress hits a 2025 low, even as maturity defaults are surging. So the CRE debt markets are sending mixed messages as we close out 2025. And on the surface, distress levels inside the CRE CLO sector have continued to improve. But beneath the headline optimism lies a growing concern, a surge in non performing matured loans that is now dominating lender attention, underwriting conversations, as well as refinance strategies. As a mortgage brokerage servicing commercial investors nationwide, Medallion Funds helps borrowers navigate these shifting conditions, and today's data tells a story every investor and operator should be watching closely. So, CRE CLO issuance surges as the markets reopen. So CRE CLO issuance has roared back to life. And through November 2025, total issuance has hit $25 billion year to date, nearly triple the $8.7 billion pace from this time last year. So what does this rebound signal is the question. Well, the big one here is a return of risk appetite among lenders. There's improved liquidity for bridge and transitional assets, and investors' confidence in sponsors with strong business plans are improving. But the healthier issuance volume also tells another half of the story. And let's talk about that. So, distress levels have hit 2025 lows, a real sign of stabilization. According to Cred IQ, the distress rate fell to 10.7% in October, which is down 82 basis points, most of a full percent month over month. And it's also down 144 basis points year over year. So CRE CLO delinquencies improved as well. It was 8.5% in October, down from 9.2% the month prior. However, special servicing inched up to 7.3%, which is also proof that many properties still face cash flow or business plan issues and still require active workout strategies. So that right there is the contradiction of today's market. Distress is falling, but also risk in certain properties and assets is rising. And here's the real threat. Non-performing matured loans spiked to 43% of issuance. So the most concerning trend is the rapid growth in non-performing matured loans, which has jumped 720 basis points to 43%. 66.3 of all allocated loan balances are now matured, and it's likely because of rates. 23.3% are performing after their maturity, while 43% are non-performing after maturity. Meanwhile, current loans have dropped to 18.2%. Short-term delinquencies rose from 0.5% to 2.5%. And this, what we're seeing right now, is the maturity wall in full effect. So borrowers who took out 2021 to 2022 vintage floating rate bridge loans are struggling to refinance into a market where there's lower valuations, higher debt yield requirements from investors, and tighter DSCR minimums. We're also seeing reduced lender leverage. Even with rate relief, the refinancing gap is widening right now. Well, there's a lot of data, but you may be asking yourself what this means for myself as an investor, a sponsor, or a lender. The story going into 2026 is simple. Headline distress is improving, but maturity risk is the real storm that we need to confront. Borrowers must know this now. Reposition your assets faster, shore up your NOI, and inject fresh equity if needed. And that way we can prepare recapitalization strategies and definitely move early on in refinancing. Things take longer than you think. Lenders, including Medallion Fund's 600 plus capital partners, are already adjusting our underwriting around these key concepts. Reduce leverage, tighter DSCR overlays, greater scrutiny of trailing 12 cash flow. I'm dealing with that particularly right now. And more conservative ARVs on traditional assets may be something that it's coming down the pike as well. So the borrowers are going to win in 2026 will be those who prepare before maturity and not after. So how can medallion funds help borrowers navigate this maturity wall? Well, we assist investors by running refinance stress tests, modeling exit DSCR valuation scenarios, and matching borrowers to bridge, bank, debt fund, or private capital, which can be a little more flexible. And that helps us structuring rescue capital when needed, also managing lender communications and underwriting. So whether you're navigating a 2025 or a 2026 maturity or preparing to acquire transitional assets, planning year early is always essential. And here's the final takeaway for the day. The improvement in CLO distress is real, but the surge in non-performing maturities is the bigger risk and the more consequential story. So for investors, the opportunity and messaging is clear. Transitional assets with strong operators and the right capital stack will be the big winners of the next cycle. Now, for borrowers, this message is even clearer. Prepare now before your refinance becomes a crisis. And we'd all don't want that. So call me today. Happy to discuss and help you prepare for your upcoming maturity refinance. BillRappOnline.com is my website. There are a lot of free tools as well. You can schedule a consultation. Thank you for your time. Have a good day.